Welcome back to The Deep Dive, your shortcut to being well-informed on the crucial conversations shaping markets. Today, we're taking a deep dive into the recent Q4 and full fiscal year 2025 results from AngioDynamics, ticker ANGO. They're the medical tech company focused on vascular access, thrombus removal, and interventional oncology devices.
Right. And the results, they dropped before the market opened, and the call itself kicked off right at 8:00 a.m. Eastern.
Yeah, and you might have caught the headlines. On paper, it looked pretty strong, actually.
Very strong in some ways.
But the market's reaction, well, that tells a much more nuanced story.
Exactly. And that's what we're here to unpack for you.
Let's get into it.
So just looking at the snapshot, AngioDynamics definitely delivered a material beat on the key metrics for Q4 fiscal 25.
Okay.
Revenue hit $80.2 million. That was significantly better than the $74.3 million consensus expectation.
And profitability.
Also a beat. Adjusted EPS came in at a loss of just 3 cents. The street expected a loss of 12 cents, so much better there.
And what really drove that top line?
It was the MedTech sales. They jumped an impressive 22% year over year.
22%, wow.
Yeah, and MedTech now makes up 45% of the total revenue mix. Plus, they generated a healthy $16 million in free cash flow for the quarter.
Okay, so strong revenue beat, strong EPS beat, strong MedTech growth, positive free cash flow. Sounds great.
It does.
But here's the puzzle, right? Despite all that, the stock took a noticeable hit, declined on heavy volume.
That's it. It signals investors were looking past the immediate beat, maybe focusing on something else.
So let's dig into that nuance, the Q4 financial breakdown. Where did the market find the anxiety?
Okay. Total revenue growth, as you said, 12.7% to $80.2 million. Breaking it down, MedTech revenue was $35.8 million. That's the 22% jump. And the med device revenue, the more traditional side, was $44.4 million. That was up a more modest 6.2%.
So clearly MedTech is where the action is. It's growing its footprint fast.
Undeniably, that's the strategic focus.
Well, what about the operational details, margins, costs?
Right, so gross margin for the quarter landed at 52.7%. But, and this is a key but, it faced a pretty significant headwind.
Oh?
Yeah, it was clipped by 204 basis points, specifically because of $1.6 million in tariff expenses.
Okay, so there's the first potential snag, tariffs hitting the margin.
Exactly. On the positive side, OpEx, operating expenses, showed real improvement. Totaled $48 million. That's 60% of sales. Compare that to $52.9 million or 74% of sales in the same quarter last year.
That's a big drop. Was that sustainable efficiency or mostly those one-time expenses they had back in Q4 24?
That's a good question. Management pointed to efficiency gains, but yeah, the comparison year did have those one-time costs. Still, adjusted EBITDA looked much better. $3.4 million for Q4 25 compared to just $1.5 million in Q4 24. So improvement there.
And their cash position, liquidity.
Solid. They ended Q4 with $55.9 million in cash and equivalents. Plus, they secured a new $25 million revolving credit line with JP Morgan. Importantly, it's still undrawn.
Okay, so the Q4 picture is strong top line driven by MedTech, but margins pressured by tariffs, offset somewhat by better OpEx and EBITDA.
That's a good summary.
All right, let's zoom out. The full fiscal year 2025. What's the bigger picture?
Okay, full year. Total revenue increased 8.1% to $292.7 million.
And MedTech, still the star.
Absolutely the star. Grew 19.5% for the full year, reaching $126.7 million. And here's a really crucial point. MedTech now accounts for 43% of total revenue.
43%.
Yeah, they've effectively doubled its share of the business over the last 5 years.
That's not just growth. That's a real strategic transformation, isn't it?
It really is. And you see that flowing through to the bottom line for the full year, too. The adjusted net loss narrowed significantly. $10.2 million or a loss of 0.25 per share.
Compared to
a loss of $18.2 million or 0.45 per share in fiscal 24. Big improvement.
And EBITDA.
Also a strong swing. Adjusted EBITDA for the full year turned positive $7.6 million. That's up from a $3.2 million loss in FY24.
So that MedTech pivot seems to be working, driving towards profitability.
It definitely seems that way. The transformation is evident in the numbers.
Okay, so if the transformation is working, but the market reacted poorly, maybe it's about the future impact of those tariffs. Or maybe something specific in the product pipeline. Let's break down those MedTech drivers.
Good idea. Let's start with the Auryon platform. Yeah. It continued its, frankly, impressive run, $15.6 million in Q4 revenue. That marks its 16th consecutive quarter of double-digit year-over-year growth.
16 quarters straight. That's consistency.
It really is. Up 19.7% in Q4. It's pulled in over $185 million in cumulative sales since it launched back in 2020.
Wow.
And it's now the third largest product in its specific market space.
And are they getting deeper penetration, not just selling to the same places?
Yeah, management highlighted that. Traction in the hospital setting is increasing. Hospitals now represent 36% of Auryon revenue.
Up from
28% at the start of fiscal 25. So yes, deeper penetration.
And are they looking beyond the U.S.?
They are. International expansion is showing promise. They booked over $1 million in Q4 revenue just from Europe. That follows the CE mark approval they got back in September 2024.
Okay.
And they're not resting there. They're putting R&D money into potentially expanding Auryon's use into coronary interventions.
Coronary, that's a huge market.
Huge, but a $900 million market just in the U.S., so potential for a significant future growth there.
All right, what's next in the MedTech portfolio? Thrombectomy.
Right. Their mechanical thrombectomy portfolio.
Yeah.
That includes AngioVac and AlphaVac. This segment is actually the fastest growing part of the MedTech business.
Faster than Auryon.
Yet delivered roughly 45% year-over-year growth in Q4 overall for the category.
45%. Okay, break that down.
Sure. AngioVac revenue was $8.2 million, up 39.5%. And AlphaVac revenue was $3.1 million, up a whopping 60.8%.
60% growth for AlphaVac.
And that marks 5 straight quarters of sequential growth for AlphaVac.
Yeah.
It's got real momentum.
What's driving that? Is it competitive wins?
It seems so. The AlphaVac Apex trial results, for example, showed it had superior clot reduction compared to some market leaders. Plus, management mentioned they're talking with the FDA about a version of AlphaVac that includes blood return functionality. That could make it even more competitive.
So they're investing here too.
Definitely. They plan to add more dedicated sales reps just for this portfolio in fiscal 26. They see tailwinds coming from the growing structural heart market as well.
Okay, Auryon strong, thrombectomy accelerating. What about NanoKnife? That one sometimes seems a bit more complex.
It is a bit different. So Q4 revenue for NanoKnife itself saw a slight dip, down 2.5%.
Okay, why?
It was driven by lower capital sales, the big machine purchases. Those were down about 25% in Q4 and down 26% for the full year. Capital can be lumpy.
Right. But what about usage? Disposables?
That's the key. Disposable sales, which are a much better gauge of actual procedures being done, remain strong. They grew 5.5% in Q4.
Okay, that's a better sign.
And even more telling, prostate procedures specifically accounted for a record 81% of all NanoKnife procedures in the quarter.
81% for prostate. So despite the capital dip, the underlying story feels, stronger.
Absolutely. And management highlighted 3 really pivotal milestones that they believe set the stage for adoption to really accelerate.
Okay, what are they?
First, the PRESERVE study. It met its primary effectiveness endpoint for intermediate risk prostate cancer, and importantly, showed compelling quality of life outcomes. That's huge for patients and doctors.
Big news. Second,
and this is massive for the business side, a CPT Category I code was granted for using NanoKnife on prostate and liver lesions. That becomes effective January 1st, 2026.
CPT I code. That means easier, more standardized reimbursement, right?
Exactly. It positions them incredibly well for widespread reimbursement across all sorts of payers. Game changer potential there.
Okay, huge. And the third milestone?
Third, they got an expanded indication specifically for prostate tissue ablation back in December 2024. That allows them to be much more proactive in marketing and training surgeons for that use.
So better data, better reimbursement coming, and broader approval to market for prostate.
Precisely. And they noted they're already seeing significant organic interest from urologists and are ramping up surgeon training.
Any other potential for NanoKnife?
Yes, actually. A CPT Level 1 code was also granted for pancreatic cancer care. That's effective a bit later, January 2027, but it broadens the technology's applicability even further.
So lots happening with NanoKnife, setting the stage for future growth.
It seems that way. And just quickly, on the operational side, remember those efficiency efforts.
Right, the manufacturing transition.
Yeah, they're still on track for about $15 million in annualized savings by fiscal year 2027. They already saw some benefit in FY25 and expect more in FY26. That helps the margin story too.
Okay, so that brings us inevitably to the guidance for fiscal year 2026. This seems to be the crux of the market's reaction.
I think you're right. So management anticipates net sales between $305 and $310 million. That's about 4% to 6% growth over FY25. Okay,
mid-single-digit growth overall. How does that break down between the segments?
Within that, MedTech sales are projected to keep growing strongly, 12% to 15% year over year.
Still strong double digits for MedTech.
Yes, but med device sales are expected to be roughly flat.
Okay. Now, the margins and profitability, this is where the tariffs bite.
This is exactly where it becomes explicit. Gross margin is guided between 53.5% and 55.5%. But crucially, as they stated on the call, this guidance includes the estimated tariff impact. They put a number on it, $4 million to $6 million.
$4 to $6 million hit from tariffs baked into the guide. Ouch.
Yeah. They even said without that impact, the gross margin guide would have been 55% to 56%. So you see the direct hit there.
And that flows down to EBITDA too, presumably.
It does. Yeah. Adjusted EBITDA is projected between $3 million and $8 million. Again, inclusive of that tariff impact.
And without tariffs?
Without tariffs, the range would have been $7.5 million to $10.5 million. So again, a significant drag.
And the bottom line, adjusted EPS.
Expected loss between $0.35 and $0.25 per share for FY26.
But they did say something positive about cash flow, right?
They did. They reiterated their expectation to be cash flow positive for the full fiscal year 2026. That's important.
Even with the tariff payments.
Even with the tariff payments. Although they did caution that they expect to use about $20 million in cash in Q1 FY26, mostly for those tariff payments and some other timing things before returning to cash generation in the later quarters.
So tariffs are definitely the big shatter over the FY26 outlook.
No doubt. Management called the environment dynamic and unpredictable. They said they wouldn't be derailed, but that $4 to $6 million impact is clearly tempering profitability guidance. That seems to be the key driver for the market's anxiety.
What about their overall strategy? Still focused inward?
Yes. They emphasize the success of the transformation into, as they put it, a profitable, growth-oriented medtech company. The focus remains squarely on driving adoption and share gains for Auryon, Thrombectomy, NanoKnife, the existing platforms, and maintaining operational discipline.
So no big M&A plans on the horizon?
Doesn't sound like it. They seem to believe the current portfolio has plenty of runway for growth, even with these tariff headwinds.
Okay, let's connect this all back to the market reaction then. The stock slid almost 5%.
4.9%, yeah. And on volume, that was roughly 4 times normal, 2.4 million shares traded.
So a decisive move.
Very. It strongly suggests investors heard the Q4 beats, applauded them maybe, but then zeroed in on that FY26 guidance, especially the explicit tariff impact on margins and profit.
And you could also argue there was some profit taking involved, right? The stock had a huge run.
Absolutely. It was up over 60% in the 12 months leading up to this. That run was fueled by real positive news, the NanoKnife prostate indication, steady Auryon growth.
Didn't it spike in March on some reimbursement news?
It did, yeah. Positive CMS news gave it a boost. Then it drifted lower in May, right around when those tariff headlines first started popping up more broadly.
And importantly, other med tech stocks, their peers, like PayN or NARI, they didn't really move much that day.
Good point. That reinforces the idea that this was very company-specific, tied directly to AngioDynamics' unique tariff exposure and how they guided for it.
Okay. So that sets the stage for our highly speculative, not at all financial advice segment.
Exactly. Let's be crystal clear. This is not financial advice. We are just tossing around ideas based on the information.
Purely conversational, hypothetical. What could one argue here?
Well, all right. Considering how strongly the market reacted specifically to that tariff guidance and weighing that against the undeniable underlying strength and momentum in the medtech portfolio.
Okay.
One could construct an argument for maybe initiating a long position on AngioDynamics around these current somewhat depressed levels.
The thinking being?
The thinking being the market has priced in a lot of that tariff anxiety. There's been significant profit taking already. But the core transformation story, it's still intact. You've got consistent Auryon growth, you've got the thrombectomy acceleration, and critically, you have those multiple huge milestones for NanoKnife for regulatory clearance, the massive reimbursement catalyst coming with the CPT code, the expanded indications. That's all setting the stage for potentially much faster adoption.
So the bet would be that the tariff impact is either temporary, manageable, or eventually gets mitigated better than the market fears right now.
Something like that.
Right.
Or that the underlying growth from NanoKnife and the rest of the portfolio eventually outweighs the tariff drag. If management delivers on those efficiency savings too, and if those tariffs somehow get resolved or absorbed, this pullback could look like an interesting entry point for someone with a longer-term view on that innovative pipeline.
Interesting thought experiment. Again, purely speculative.
Absolutely. Not advice.
So let's try and wrap this up. What does this all mean for you, the listener? AngioDynamics delivered a robust Q4 on the surface. Strong revenue, medtech powering ahead.
Definitely. Significant progress in that portfolio. However, the outlook for fiscal 26 is clearly dampened by those anticipated tariff impacts. That seems to be the main reason for the market's immediate disappointment.
The company is definitely continuing its strategic shift towards being a profitable, growth-focused med tech leader. And there are genuinely exciting prospects there, especially with Auryon, thrombectomy, and particularly NanoKnife with those catalysts lining up.
Right. It really highlights how critical it is for investors to look beyond just the headline beats and earnings. You have to dig into the guidance, understand the specific headwinds, like these tariffs. That's where the real story often lies.
As always, everything we've discussed here is for informational purposes only. It is definitely not investment advice.
So as you digest all this, what stood out most to you? Is this tariff issue just a temporary blip on what's otherwise a strong transformation story?
Or is it a more persistent shadow that's going to continue to weigh on them as they try to execute on that medtech potential? Something to think about.